A small Nigerian company has just reported what looks like an extraordinary turnaround. Revenue climbed 28%. Profit reached 1.2 billion naira. Shareholders' equity nearly tripled in a single year. At first glance, this looks like the kind of hidden value opportunity every investor hopes to find. But once you look beyond the profit and follow the cash, a very different picture emerges. The accounts show a profit of more than 1.2 billion naira, yet the company may have struggled to make it through the year, but for one strategic save. Then there's another red flag. Sitting on the balance sheet is a mysterious liability even the management cannot explain. So which story should investors believe? The recovery shown in the financial statements, or the warning signs hiding beneath them? That's what we're about to find out.
Welcome back to Behind the Numbers TV, the channel that breaks down financial statements in plain English. No finance degree required. First, we look at the business. Is it actually growing? Japaul Gold Ventures plc wasn't always a mining company. For years, investors knew it as Japaul Oil and Maritime Services, a business built around marine logistics and dredging. But over the past few years, the company has quietly reinvented itself. What began as a marine services company has expanded into stone crushing and, more recently, gold mining. The financial statements suggest that transformation is beginning to gain momentum. Revenue increased from 4.10 billion naira in 2024 to 5.25 billion naira in 2025, a healthy growth rate of just over 28%. But there's an important detail hiding beneath that headline. Almost 98% of the company's revenue came from a single business division, the offshore vessel and equipment rental division. The stone crushing division contributed only a small fraction of revenue. Meanwhile, the dredging division, the business on which the company was originally built, generated virtually no meaningful revenue during the year. The concentration doesn't stop with revenue. When we look at where the group's profits actually come from, we find that the listed parent company itself has reported losses for 5 consecutive years. The profits investors see today are being generated largely by other companies within the group. So is the business growing? Yes, but it is concentrated in a single operating division, while the parent company continues to struggle. That doesn't mean the turnaround isn't real. It simply means the foundation is much narrower than the headline numbers suggest. And narrow foundations deserve careful testing before they earn investor confidence. Which brings us to the next question. If the business is improving, how much of that improvement is actually turning into cash? At first glance, profitability appears to be moving in the right direction. Gross margin improved from just over 52% to almost 57%, suggesting the company earned more from every naira of revenue than it did a year earlier. A more efficient business, on paper. But efficiency was supposed to show up in the cost line too, and it didn't. While revenue grew 28%, administrative expenses, salaries, director pay, legal fees, and security grew almost 88%, nearly 3 times the pace of revenue growth. Simply put, costs expanded much faster than sales. Then we arrive at the number that matters most, profit. Japaul Gold Ventures reported a profit after tax of 1.22 billion naira. Yet operating activities consumed 4.29 billion naira in cash. Think about what that means. According to the income statement, the business made money. According to the cash flow statement, it spent far more cash than it generated. That raises an obvious question. If the business wasn't producing the cash it needed, where did the money come from? The answer? It didn't come from more customers or customers that paid faster. It came from investors. During the year, Japaul raised approximately 11.5 billion naira through the issue of new shares. That fresh capital funded investment, strengthened liquidity, and supported the company's operations. Without that capital injection, the company's own cash flow numbers suggest it would have struggled to finance its operations through the year. So, can investors trust this year's improvement? Yes, but only up to a point.
The company's revenue growth and higher gross margins suggest that the operating business is moving in the right direction, but the quality of those earnings is less convincing. If the business improved, the next question is whether that improvement actually reached the people who own it. Earnings per share says no. Despite revenue growing by 28%, earnings per share fell from 13 kobo to 9 kobo. Why? The answer is dilution. During the year, the company increased its number of outstanding shares by roughly 39%. Imagine the company's profit as a pie, and each share as a claim on that pie. The pie became a little bigger, but it was cut into 39% more slices. So even though the company earned more in total, each individual share ended up with a smaller piece. That's why earnings per share fell. For existing shareholders, this is an important distinction. The company became more profitable overall, but because so many new shares were issued, each share received a smaller share of those profits. Book value tells a different story. Net asset value per share increased from approximately 2 naira 95 kobo to 3 naira 29 kobo, while total shareholders' equity rose from just under 8 billion naira to more than 20 billion naira. Those are meaningful improvements. But it's important to understand what drove them. Most of that increase came from issuing new shares, rather than from profits retained by the business. Some of those shares were used to acquire a gold mining license from a company associated with the former chairman. That distinction matters, because building shareholder value through retained earnings is very different from building it through raising fresh capital. Both strengthen the balance sheet, but only one reflects wealth created by the business itself. There is, however, one clear positive for shareholders. A dividend of approximately 4 kobo per share was paid during the year from the previous year's profits, the company's first dividend in 5 years. At the same time, the directors chose not to recommend a dividend from this year's earnings. Given the company's deeply negative operating cash flow, that decision is understandable. Profit may have improved, but the cash needed to support regular distributions has yet to follow. So, did shareholders benefit? Yes, shareholders did come out ahead this year. A stronger balance sheet, a dividend, and book value climbing. But almost none of that gain was earned in the traditional sense. It was funded. And that raises an uncomfortable question. When a management team is handed 11.5 billion naira of other people's money, rather than money the business made itself, what do they actually do with it? That's the test this section is built around. There are genuine improvements here that deserve recognition. A year ago, current liabilities exceeded current assets. Today, the company has moved back into a positive working capital position. Debt remains modest, and the company earns roughly 12 times what it owes in interest, a genuinely strong number. A closer look, though, shows that the improvement is mostly an illusion of scale. Total liabilities didn't shrink. They grew instead, from about 15 billion naira to over 17 billion naira. In other words, the balance sheet improved largely because investors injected new capital, not because the company reduced what it owed. There is one more number on the balance sheet worth examining. This number, buried within other payables, is a balance of just over 2 billion naira, labeled adjustment account. The accompanying note states that the directors are yet to provide the basis and makeup of these amounts. In other words, the financial statements contain a liability of more than 2 billion naira that the company itself cannot provide a breakdown or explanation for. There is also the matter of the mining license behind the company's entire pivot into gold. It is worth 11.4 billion naira, more than half of everything the company owns long term. It was bought with shares rather than cash, from that company tied to the former chairman we mentioned earlier. The independent auditor reviewed the valuation and called it reasonable. But an asset this size, funding a mine that hasn't produced a single ounce of gold yet, deserves continued attention, not a passing glance. When you add these to a prior year that had to be corrected for real accounting errors and a late filing penalty from the exchange, then a pattern starts to form. Japaul Gold Ventures is not a company in crisis, but it is one whose bookkeeping discipline still has real gaps.
So what did management actually do with the stronger balance sheet? They spent it on a bet, not a repair. The extra strength didn't go toward paying down what the company owes. Instead, it went into an unproven gold mining asset, bought through a related party transaction, while a 2 billion naira liability on the books still has no explanation. Management used the recovery to fund a future they haven't built yet, rather than to fix the present they're standing on. That's the bet our fifth question has to put a price on.
After everything we've uncovered, one question remains. Does Japaul deserve an investor's capital today? At 3 naira 24 kobo per share, the numbers split into two completely different stories, depending on where you look. If you compare the share price with the company's book value, Japaul appears fairly valued. The stock trades at almost exactly its net asset value, with a price-to-book ratio of about 0.98 times. But compare that same price with earnings, and the picture changes completely. Based on this year's earnings, investors are paying roughly 36 times earnings, an expensive growth stock valuation for a company whose earnings per share just fell and whose operating cash flow ran deeply negative. At 3 naira 24 kobo, the market is most likely paying for the gold mine that hasn't happened yet. If that segment starts producing real revenue as planned, this valuation might look justified in hindsight. If it doesn't, investors are currently paying a growth stock price for a company that, on this year's numbers, isn't generating growth stock cash.
So, should investors buy Japaul? Here's my verdict. For new investors, watch. Don't buy yet. At 36 times earnings, the market has already priced in a gold mining success story that hasn't happened. I'd want to see at least one more reporting period, one where operating cash flow turns positive and that unexplained liability gets resolved before putting new money in. For existing shareholders, hold. The business is undeniably healthier than it was a year ago, and the long-term thesis hasn't broken. But the next chapter needs to be judged on one thing above all else: whether profit finally turns into cash.
That's it for Japaul Gold Ventures plc. Audited full-year financial statements for the year ended 31 December 2025. If there's one thing to remember from today's analysis, it's this. Japaul has bought itself time, but it hasn't yet proven that its business can consistently turn accounting profits into cash. Until the cash catches up with the story, caution remains justified.
Before we wrap this up, remember, this video is not financial advice. It is for educational purposes only. Always do your own research or consult a licensed financial advisor before making investment decisions. Now, I'd like to hear from you. Would you buy, hold, or avoid Japaul at today's price? Let me know in the comments below. If you enjoy evidence-based investing without the hype, subscribe to Behind the Numbers TV, because every number tells a story, and together, we'll learn how to read it. See you in the next video. Thanks for watching.